My name is Andrew Romans, and today I want to give a quick overview of our fund of funds, investing in VC funds as an LP, and our direct venture capital funds, which cherry pick investing in the best startups of the best performing VC funds, and why we're doing this. So, why are we doing this? We've been running direct venture capital funds for decades that have achieved consistent 6x plus cash on cash multiples, putting us in the top decile, outperforming 90% of other VC funds. And what has changed in driving us to do this are two things. The big VC funds that everyone's heard of that were founded in the 70s, 80s, and 90s have gone from being venture capital funds to mega funds that are almost really hedge funds. They used to invest in early stage and exit after an IPO or M&A where there was a big delta and they made big returns. Now, if you have a $3 billion fund or $1 billion fund or $750 million fund, and you have to deploy this in a matter of 24 months, you're investing most of it in growth. So they basically are investing at a higher price than if the company went public today, because it's so competitive with crossover funds from hedge funds coming in that they overpay and they have to grow with years for that company to grow revenue to achieve any kind of profit. So their entry point price is not far from exit. Basically, big funds, it's just math, are not delivering alpha. The other thing that's changed is there's been an explosion in the number of funds. There used to be 50 funds in New York when I opened our New York office, flying back and forth from Silicon Valley. Now there's over 1,200. We went from 50 funds to 1,200. That is difficult to track. It used to be that you didn't need a fund of funds if you were in the game because you have direct access to invest in these VC funds yourself. Well, those funds are no longer getting good multiples. And now, how much work are you ready to do to track 4,000 funds in the Bay Area and 1,200 in New York, and funds popping up everywhere? So there's been a big increase in the number of funds. It's basically founders turn VC, and it's alumni from big tech corporates like Google, OpenAI, Palantir that really understand AI, that are launching small funds, raising money from their network. And don't be surprised, these funds are delivering alpha. So funds above 250 million in size fall off a cliff, delivering worse results. Funds under 250 do much better. Funds under 150 do much better. And funds under 50 million are delivering the highest returns in the industry right now. So on the one hand, we are investing in the best performing VC funds with a discipline for lower fund size. And on the other side, we're cherry picking. Now, our approach to investing in a fund that's on fund 1 through fund 4 is that you're not established enough for us to commit now. We don't have decades of information on you. So let us know when you have your final close. And if the fund is up and it looks good, we'll commit 20% in your final close. So these VC funds are raising money for 24 or 36 months where they're already deploying money, and some of their startups are raising money at much higher valuations. So at the time that we commit 10 million and bring a fund from 40 million to 50 million, our 10 million might be worth 15 or 20 million at the same instant we invest that. So we benefit from the fact that some of their startup investments are already up. And we benefit from looking at every single company in that portfolio before saying yes or no to become an LP in that fund. So it's almost like we're buying shares in Microsoft today at a lower share price of 2 years ago. And that's just how it works with emerging managers. With the more established emerging managers who've got longer track records and hitting top decile, we don't have the luxury of coming in at the end, and we need to be happy to be getting into those funds, period. And we knew many of those individuals when they were founders, when they were corporates, when they were angels, before they opened those VC funds. So on the direct cherry pick, we're doing two things. We're looking to invest in the primary, where we're funding the growth of that company, investing alongside other VCs. And we're also going to these VCs and saying, you're going to struggle to raise your next fund if you haven't already distributed cash from an IPO or M&A or secondary to your LPs. And so typically, we're living in a moment in history where we have the biggest spread ever between TVPI, unrealized gains, markups, and DPI, cash distributions. So if we came in the final round of that VC fund as an LP, we say, when are you going to raise your next fund? And they say, pretty much in a week. I have to get working immediately. And we say, well, let us help you return at least 1x cash to your LPs, and they'll be more likely to invest in your next vintage fund. And you'll be more successful attracting new LPs saying, I'm in the top decile on DPI, cash distributions. So what that looks like is we'll look through their top 5 startups where they've gone up in value and offer to buy 10% to 50% of the shares they own, sometimes even at a 10 to 50% discount. This enables them to return their fund faster. And even if they don't take that discounted secondary from us, we're encouraging them to then sell 10 to 50% to the mega funds in their next funding round. The mega funds struggle to move the money, and they want to buy preferred secondaries from all of us little VCs. So we're driving DPI and we're accelerating the time to pay back our LPs and our FoF because we're buying secondaries and we're encouraging them to sell secondaries at full face value of the next up round financing. So the direct fund cherry picks buying primaries and secondaries, sometimes at a discount. We're getting into the best deals of the best performing VC funds in the business. So we've come to the conclusion that it makes sense to outsource a venture capital program to an FoF that's highly motivated to do the work, to look at every single startup inside the portfolio before investing, because we're seeking to cherry pick and we're driving liquidity across the entire stack. Our direct fund as well believes in selling shares into up rounds because we know that we need to have the best DPI, cash distributions, to have our LPs happy to follow us into future funding rounds. We're also operating with a new level of artificial intelligence that enables us to track thousands of VCs and tens of thousands of startups in an automated manner, something that makes sense to outsource. And if you try to do this yourself, you probably need to spend more cash on resources than our very thin layer of FoF fees that is on top of the alpha portion of the VC stack. In closing, I'd like to invite you to meet us in person. We are hosting the Global VC Demo Day, where rather than an event company that just charges money to any VC to present on stage or be on a panel, we only feature the best performing VCs at our events. So we handpick 7 VCs to give a 7-minute demo day presentation, followed by a 2-hour high-end networking reception for institutional and high net worth LPs. And so we're bringing together the LP in high performing VC community on a regular monthly basis. And we're hosting these events in New York, Los Angeles, Austin, Texas, Miami, and London, Singapore, Dubai. So please come and meet us at the Global VC Demo Day or one of our small, intimate VIP dinners. We host small dinners for 10 to 20 people the night before and the night after the Global VC Demo Day. So hopefully you can meet us in one of these cities, meet us in person, and see if we can collaborate and work together.